Today, we're tackling one of the most pressing issues in real estate, housing affordability. With rising mortgage rates, a national housing deficit, and inflation putting pressure on American wallets, many are finding it harder than ever to balance their housing costs with other financial goals. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
I am so excited to say we will be joined today by two incredible experts to help us unpack the challenges surrounding housing affordability today. Orphe Divounguy, senior economist at Zillow, and Lu Chen, senior economist at Moody's, will break down the data, explore the ripple effects of affordability issues, and share insights into how housing affordability is reshaping the housing landscape. Orphe and Lu, welcome to The Real Wealth Show. This is going to be a geek fest, okay? Let's do that. And Orphe, let's start with you. How do you at Zillow define housing affordability? It's been a hot topic these last few years.
Yeah, so the way we do this is, we look at how much people spend on housing as a share of their income. But ultimately, the objective is to try to quantify how large the barrier to access housing has become, right? So you have the one-time costs and fees that new renters and home buyers face, but you also have, of course, these recurring monthly costs, and we want to try to capture all of that in our Zillow housing affordability dashboard. And so you can go on the zillow.com/research page and actually see what people are paying, what at least the middle income household, the median income household would have to pay in order to access housing today. So that's how we do it. We see when we do that, what we learn is that the median income household moving into a new rental unit would pay roughly 29% of their income on housing costs, right? That was up and peaked in 2022 and is still higher than it was before the pandemic. When you look at a buyer today, well, it's much higher, around 34% of their income spent on housing costs, up from an average of about 25% before the pandemic. So housing costs as a share of income have actually increased in the past few years. When you look at whether or not wages, when we compare rents to wages, we see a big increase in rents during the pandemic when compared to labor income, essentially earnings, wage earnings on average. And so that discrepancy, that gap, has made housing less affordable today, relative to before we went into the pandemic.
Mm. And Lu, at Moody's, do you look at it any differently, or is this how you define housing affordability as well?
Oh, we look at the housing affordability in the exact same fashion as Orphe alluded to earlier. It's such an extensive way and very academia way of measuring the housing affordability challenges on the rental side as well. So we look at the recurring cost on the rental market. So primarily, the data we track in-house is the average rent. But ideally, we would like to look at the utility cost, the rental cost, so all those recurring monthly costs as a percentage of the household income. So just to pivot into what's going on the rental market side, we are also seeing the headline number is seemingly suggesting some relief on the headline, mainly because the rent level has been really decelerating from its peak, while the labor market has remained to be resilient and defying the expectation to many aspects. So that continuous growth of the household income has been supporting that rental growth, especially over the past 2 years. So bringing us pretty much back to the pre-pandemic level in terms of the rental income ratio. So the headline number, yes, right now I was just looking at the data yesterday, and I hope we have shared the latest with you, has been back to 27.4%. But I would put a huge caveat on top of that headline number, and I'm pretty sure Orphe would agree with me, because when we look at the headline number, it suggests a directional changes because of the denominator effect.
For those of us who aren't economists, what do you mean by headline number?
the headline number is really that one simple average number, the 27.4%, which essentially put us back to the 2019 level. So that is the headline number, which is the overarching picture we are depicting here. But as an economist, whether that's at Zillow or at Moody's, we care deeply into the renter household and the distribution. I'm pretty sure, Kathy, we can touch upon all those details as we move the conversation into the later part of the show.
So I think what I'm hearing is you're saying that on the rental side, it's gotten better because wages have gone up and rent growth has slowed down. But Orphe, is that what you're seeing in for home buyers, for home, people wanting to own a home as well?
Backing up a little bit and supporting some of the points Lu just made, part of the reason we've seen rent growth ease so much is a 5-decade high in apartment supply. So we got a big increase in multifamily construction that is really that's caused the rental vacancy rate to increase. And as the number of rental vacancies increase, of course, you get downward pressure on rents. Zillow data shows we have the largest number of rental units offering a concession to renters on the platform today in our records, right? And so really important to highlight the big role that builders have played during the pandemic in building more housing, especially multifamily housing, and that's helped tremendously in bringing rent growth back down to earth. So that's what we're seeing on the rental market. Is in the last year or so, wage growth has actually outpaced rent growth and has helped improve affordability in the rental market.
So supply is better on the rental side, but are we seeing that in the home sale side? Is there more increased inventory for homes for sale that would also drive prices down in the same way?
Yeah, so things are worse on the for sale side in terms of affordability. However, we're seeing an improvement also, right? The number of existing homes for sale has actually increased over the past year. That has helped to loosen the housing market a little bit. But we also know from Zillow data that a large share of existing homeowners who sell their homes end up buying again. And so that doesn't necessarily, help improve housing affordability, bring prices down to earth all that much. We've seen a big increase in single-family construction during the pandemic. And of course, in the past year, single-family starts the past 2 years, single-family starts have declined a little bit, right, as mortgage rates increased. But as of earlier last year, in 2024, the single-family starts in single-family homes was still higher than the level observed before the pandemic. And so we are getting some help on the supply side, but unfortunately, things are still very tough out there for buyers because mortgage rates have remained somewhat elevated.
So Lu, some of the reasons people or the blame that many people put on these high housing costs and lack of affordability, sometimes they will say it is investors. It's institutional investors, Wall Street buying too many houses, too many investors buying Airbnbs and taking them off the market. Would you say that those two things play a role in housing affordability, or is it something else?
Absolutely. I will start off the conversation, but I'm pretty sure Orphe has more to add because Zillow does track single-family rental data. So usually in the general housing ecosystem, we would love to see the trading up options, right? So the renter being traded up to the single-family housing, or even within the renter household, people trading up from Class B, C, older stock into amenity-loaded newer stock. So that is the healthy evolution of the housing ladder to a certain extent. And the recent disruption in the housing ecosystem caused a lot of the renter household being constrained in the rental market for longer. So if you look at the tenure, and just based on the ACS data, American Community Survey data that Census published, comparing 10 years ago, versus the latest data, which is up until 2023, you clearly see the increase of number of renter households staying put in their rental units for 5 years and above, 10 years above. And those renter household in the healthy ecosystem should move up to the single family housing system. But because of the barrier, whether that's we use different measures, Orphe. We use the price to rent ratio. We look at the premium, comparing the monthly mortgage payment in comparison with the monthly rent. But by all standard, we are seeing the gap for the first-time home buyer to move up from the rental market to single-family rental has become much more challenging, right? I'm just taking the state of California as an example, not because of the wildfire, but rather I live personally in the state of California. So when you look at the price to rent ratio, you can easily see that ratio doubled, meaning mortgage to the rent ratio doubled in places like San Jose, San Francisco, Los Angeles, up and down California. And that is really just showcasing how challenging just to move up from the renter household to the single family homeowner become challenging in places like the state of California. And the institutional investors coming into the play and providing some of the rental options alleviate some of that friction, but still it doesn't really solve the problem. And in many cases, because of the higher rent premium that we are seeing between the rental market versus single family rental versus the home mortgages, just really make the situation even more challenging in most recent years.
Absolutely. In places like California, I really just question whether it even makes sense to own a home, to move out, like you said, from a rental to maybe the same type of home next door that's going to cost you twice as much if you bought it versus renting it. I mean, Orphe, does it make sense?
It totally makes sense, and that's why Zillow data shows that the typical renter is now 42 years old, up from 33 just before the pandemic. So
Wow.
massive change, right? So renters are staying renters for longer, partly because there's this challenge in moving into the for sale market. You were talking about Los Angeles. We did an interesting exercise, right, to kind of illustrate the affordability challenge that's out there. Is we basically said, well, if you were the median income household, how much of a down payment would you need to keep your monthly cost at 30% of your income? And in Los Angeles, I believe that number is something like $780,000, right? And that's just the down payment that would be required to keep the monthly cost at 30% of your income if you were
Wow.
just the median income household. And so it makes sense. It makes sense when you see that basically the California, Los Angeles in particular, has some of the highest share of renters as opposed to homeowners, right? When you compare across the country, fewer people own their homes on the expensive coasts than in other parts of the country that maybe build more housing and where house prices are somewhat tame, rather than on the coast where prices basically were uncontrolled for so long, right? Ran up for so long and so much higher.
I mean, that's the advice I give to people who are local living in California or other high priced markets is, why? Maybe it's not a wise decision for you to buy a house right now. Maybe it's better for you to rent and buy investment property instead. Lu, what are you seeing as opportunities for people to be able to still make the numbers work to buy property, but as a rental? And I'm talking from a landlord perspective, if you have that data.
I don't really have that data, but I do have an interesting piece of story maybe I can share. So we look at the very broad level. If anybody were to make investment in the rental market and through a longer horizon, how the effective revenue has been growing over the years in comparison with, say, the general inflation rate, because we would like to compare and contrast, would that investment be even even be worthy in comparison with the general increases in price, whether that's goods or services. And if we trace back all the way to the beginning of the century, and if you look at the longer term, and multifamily, even given the recent crazy movement, right? So Orphe see that as well in the Zillow data. We have that crazy double-digit annual rent increases right after the pandemic, and now we are seeing that flatline or even in some cases downward trending rent growth. But largely speaking, we are seeing the effective revenue growth in multifamily has continuously beating the inflation as long as we expand that horizon. And the reason was really because of the resilient rental demand. So some of that rental demand was coming from the demographic factors, right? So we are seeing the renter household, especially the millennials and the older Gen Zers, have been moving and staying in the rental market for longer, and that really secured a lot of that rental demand. And also 2024, so Orphe and I were looking at the census data. I'm pretty sure the teams were also just looking at that. Nearly 1% of the population growth between July 2023 to 2024. And that was a record level, which we haven't been recording such numbers since the beginning of the century, right? So that was really the tailwinds we are looking forward in terms of the multifamily investment, and also that construction boom we have been talking over the past 2 years now, because that population growth is all what we needed to secure this long-term investment gain and the healthy return in the multifamily market. And that population, although part of that you could argue was coming from the immigrants, right, which is in contrary to what we have been seeing historically, the natural births minus deaths was contributing to that big bulk of the population gain. But this time around was very peculiar. And immigration is interesting that we talk about them, because when they first enter the United States, they are primarily renter household. So although the household formation isn't always in the linear relationship with the population gain, but the most recent 2 years was featuring that booming in immigration and renter household growth because of that composition in the population gain. So that is really just depicting a lot of brighter picture in pockets like Florida, Texas, so all those traditional California, in the states where traditionally are welcoming the record level immigrants in comparison with other inland states such as the Carolinas, Tennessee. So all these different states which feature strong domestic immigration. So they continue to get that lifestyle, job opportunity, and other boosts, which continue to draw people moving from other states into their states. But the coastal states, in particularly, where we see the construction boom, are getting that welcoming sign from the immigrants. If that turned out to be more sustainable, and then it will provide that long-term tailwind into balancing out this multifamily supply and demand and providing that economic return which investors are needing. But a lot of that is also bolstering a lot of uncertainties and volatilities coming into the near future.
Wow. Orphe, your thoughts on that?
Yeah, so I worry a little bit, right? And here's why I worry. Because what we've seen is we have had this strong population growth, and now we're seeing builders pull back. So we look at multifamily starts; they've been on the decline. So homes get started and they go under construction, and and eventually they come on the market, right? And so if we get a big multifamily start pullback in 2023 and 2024, then chances are we'll see fewer apartment buildings being completed in 2025 and maybe even in 2026, right? And so maybe, just maybe, the rental market will get a little tighter. There won't be enough supply to keep up with the continued population growth. And for someone like me who has been looking at like the size of the housing unit deficit in different markets and across the country, I worry because I would like to continue to see builders continue to build in order to close those big deficits, especially on the coasts, right? Those coastal markets are already relatively more expensive and have some of the largest housing unit deficits in the country.
Interesting. So I think what you're both saying is that the coasts are going to possibly have a low supply of multifamily in the next couple of years.
Yes,
No, sounds like an opportunity.
that could potentially exacerbate existing deficits.
Yeah.
And then you add, of course, what's going on with the hurricanes and fires, and that is, to me, that's worrying in the sense that we can get some upward pressure on rents again, right? And remember, rising housing costs and deteriorating affordability is, in my opinion, a risk to sustainable economic growth. We saw what happened when housing costs increased, interest rates, inflation surged, rents 40% of core inflation surged, and of course the Fed had to react by raising interest rates, right, in order to cool off the U.S. economy. And so, the increase in housing costs due to these underlying issues, right, these massive shortages, to me, is a risk to sustainable economic growth going forward.
Yeah, I would like to piggyback this broader picture because what we have been seeing is this upside down V-shaped housing starts by all measures, right? We look at the absolute housing starts, but we also look at per capita style housing starts. So we did an interesting exercise in the team where we pair our household number and incremental household together with the housing starts. And we immediately spot on that suppose the booming housing, multifamily housing construction, that boom has been muted once you divide that by the incremental household.
Yeah.
So this is like a very interesting analogy we usually do. So during the recessionary period, usually you see the housing starts will go downwards. But if that's paired with a slowdown in population growth, it's less of a problem. But we are seeing, while the population continue to grow, but the sustainability of that housing starts isn't sufficient. That 2 years of the construction boom isn't sufficient to close the gap. So I'm pretty sure Orphe and Zillow has a different estimate of the housing deficit because there's a wide range of how many housing units we actually need in the marketplace. We took a little conservative view because we look at the long-term vacancy. So speaking of the long-term vacancy, that usually we take that as a gauge of the market balance. And we should not be so naive to look at what's going on over the past decade or so, pre-leading the COVID era, as a standard, because that was the era which features the motivated housing construction and the growing renter population. So it has actually below long-term average vacancy in that 10 years, which led us to essentially 1.5 million to 2 million housing deficit, which includes both single-family housing and multi. Zillow may have a different number, but we all agreed on we are facing this large gap of how much housing we actually need. And looking at this upside down V shape of housing starts on the rental side, it just really depicts that bleak picture. If we continue getting that sustainable demand, and then that'll catch up with this frictional oversupply. So the investor is going to be a little more patient because sometimes it really takes that quarters and up to a year for your full to reach that stabilization phase. So we have also recorded that absorption rate, right? At the completion of the building, you're probably looking at 55% or 60% occupied. And then over the next few quarters, and you gradually just increase that occupancy over to, say, 95% of the total number of units. So right now, that time is a little longer than expected, but we needed that time for the demand to catch up. So I hate to see that discouragement from the development side that, well, only because it takes longer, only because the prevailing interest rate is a little higher than before time, and we should stop building. But it should be the contrary, that the more building supply that we are seeing, the more likely we are going to see this free movement among household and being able to see them trading up and moving up the housing ladder. And that'll encourage some of the lower income household to finally being able to grow their household. Because we did an interesting study, not on the Los Angeles market, but on the New York market, where we see probably the ownership and renter composition flipped with the national average. So instead of having 2/3 of the household being the homeowners, they probably see 2/3 of the family being renter household.
Mhm.
It's really coming from that housing and affordability. So if we put up the living wage, so we use the MIT Living Wage Institute that they study what is the bare minimum income which will support your living necessities, right? Using that living wage standard, depending on whether this is a two adult household, whether you have kids, no kids, how many kids you have, how many adults will be working. And in many cases, we found to make sure the housing is not a burden given their living wage standard, and they have no choice but to live with a roommate. So that really compress the household formation. So we would love to see that household to grow in the linear fashion with the population, which we haven't been able to observe over the last 2 years. We are actually seeing a much muted growth when it comes down to household formation in relationships to the population growth. So that is what, as a society.
I love what Lu just said. Using she's alluded to the census data and using the same data, if you actually look at the number of families that are living with non-relatives. So essentially, you're doubling up, not by choice. You're not living with family members. You're living with someone you don't actually know, right?
Yeah.
A different family altogether. You're sharing a tighter space with people that are not related to you. When you count those families and you compare them to the total number of available rental or units for rent or for sale in any given year, right? In 2023, the gap was 4.5 million units. In other words, even if I gave all those families the resources to go out and find a unit of their own, they wouldn't be able to find one because there's just not enough units to go around for everyone in the country. And that's how we look at measures of the unit deficit across the country. Because we abstaining from making any assumptions about household formation. If you just compare people that are stuck living with non-relatives to the number of homes that are available for rent or for sale, you see a massive gap, right? And closing that gap will require building more, way more than the 1.5 or 2 million units we build every single year.
Wow. Yeah, I hadn't really heard anyone say that. We've been focused on build to rent and communities, and particularly in San Antonio right now. And I went to the IMN single family rental conference in December. We had some Real Wealth members there, and they said the same thing that you said about apartments, that there is just a gap of new starts, build to rent starts. They're really slowing down, and that this is going to show up as a problem in 2026 as just, again, not enough supply. So hopefully we're in the right business here in the build to rent community, because not everybody wants to live in an apartment. Some people would still like to have a home, but not own it at this time.
I mean, our data shows that these renters are older. Some of them are now have kids. Most of them have pets. And so some of them might not want to continue to live in an apartment, right? We do have people that are younger that want to live in apartments. They want to be close to the amenities in the big cities, closer to jobs. But you also have that older renter with a family who just can't afford to make the move into the for sale market. And that's where that supply of single family rentals really is key to help them, right? I don't think preferences have changed. Like, people are not staying renters for longer because they're choosing to necessarily, and their preferences have changed when compared to the past. I think affordability is probably the big driver in why we're seeing renters, the typical renter, aging into a single family rental as opposed to buying the first home.
Yeah, I mean, it just might be a better financial decision if your rent is half what a mortgage payment would be. Why would you do that? You'd invest that difference elsewhere.
Yeah, more so of a constraint as opposed to like,
Mhm.
hey, I'm choosing this. I think most people would probably in that bracket, right? These older millennials with children who don't want to uproot their kids
Mhm.
from their local school because they have to move out of this rental unit. They're constrained, right?
Yeah.
It's not that they're choosing necessarily because their preferences are changing. It's mostly that it's a constraint. It's when you, as economists, you refer to the budget constraint, right? The math just doesn't add up to make the move into for sale, and so you're stuck having to rent the single family house and staying a renter for longer.
Well, during the pandemic, we saw a lot of migration changes, people moving to be wherever they wanted to be. Are we still seeing demographic shifts of people moving maybe now more for affordability reasons? Or has it gone back to the way it was before?
Yeah, I could start with the migration discussion because we do monitor the in and out migration very closely. And also because I'm in the Bay Area, this is a constant topic we brought up over and
Right.
over.
Yeah.
I see my neighbors, friends, classroom parents all leaving the Bay Area to Texas. So I see it all. The
Mm.
migration, the in and out migration, the people flow has certainly slowed down from um, I know Moody's wouldn't like me to say this great migration because it implies a different themes altogether, but we do see a heightened movement during the 2021-2022 era for various reasons, because of the preference and changes of lifestyle, because of the flexibility of
Mhm.
remote working, because of people folding their household and living with family and friends for temporary reason. And we see the reversed, which also caused that people in and out migration flow. And everything tend to slow down quite a bit in 23 and 24. A lot of the states, including some of the top migration destination like Florida, has been losing their top ranking position in the latest census data, which is really a suggestion and illustration of the reverting to normalization, which we have been seeing pre-pandemic. Um, Migration is a healthy thing when it comes to churning and just flipping through the rental availability and just encouraging some of the price dynamics. And the slower migration is really suggesting people have been settling in. But through this migration theme, we did see a lot of the interest in moving into the more affordable area. I saw it from the rental market and I saw bits and pieces on the single family side as well. Orphe may have more data suggesting on the single family, but just on the rental, some of the Sunbelt places where we did see the great price increases has really traditionally been providing that affordability reassurance, right? If you look at Austin, the latest data suggests its rent to income ratio, the headline number. So if you put the average rent and divide that by the median household income is below 20%. So that continues to draw a lot of those migration inflow into uh, Austin and its surrounding area. And of course, the job opportunity is another big reason. So the supply chases upon all those migration flow as well. It draws the migration. It also chases after the migration. So we see
Mm.
a very healthy dynamics being played out in those migration hotspots. But I have to say, a lot of that, because of the last 2 years, the affordability has been really showing some easing. So that driver is still there, but just not as strong as before.
Yeah. So I'd like to offer maybe a similar perspective. So a couple factors, right? So before the pandemic, we had seen, if you look at the long run trend, you had seen migration decline tremendously over time, and then you got this big surge during the pandemic. The surge during the pandemic coincided with the big drop in mortgage rates. We also look at the labor market, and what did you see in the labor market? You saw quit rates super elevated, job opening rates uh, through the roof, more job to job transitions. And I like to say where the labor market goes, so does the housing market. When people are moving because of opportunities, right, and they have more options in the labor market, you tend to see a lot of migration too, right? And we got a big migration uptick and a lot of residential mobility, right, across the U.S. Of course, you had some work from home that also helped a little push people to some areas. But ultimately, I think over the long run, what we learned from Zillow data is that people move where it's more affordable and where there's more supply of housing, because there's more available inventory, a greater mix of housing options, right? So people will go where it makes sense for their budgets. And right, one of the big movers, jobs. Second, housing, right? And that's also from census survey data. And then, of course, then there's these other factors, like like the sun, for example, right? But really, jobs and housing are big drivers. And so what we see now is this kind of reversal. We went from the Great Resignation, where people were moving from job to job, wage growth was through the roof. There was a new job opportunity calling you left and right, and you were moving housing, or maybe even moving to remote places because you could work remotely, right? And then we went to this kind of the great stay, where basically quit rates are as low as they've been in a decade. The number of job openings is coming down. There's fewer job-to-job movements, and all of a sudden, there's also less movement in the housing market. Fewer people moving. You have, and then of course, to add to that, the fact that people have low mortgage rates with really low monthly payments, and they don't want to trade up to trade to a higher mortgage rate. So all of those factors are really influencing kind of the headline numbers that we're seeing on the migration front, right? So I'm not surprised that with the cool down in the labor market, you don't have as many outflows from the cities like San Francisco that were losing a lot of people just during the pandemic.
All right. So as we wrap up, do you see any solutions to this affordability crisis? Is there a chance we'll see rates come down? Is there a chance we'll see more supply coming? Lou, what are your thoughts?
Sure. As we saw over this mini cycle, I would like to describe the beginning of the pandemic up until now is really just give us a lens through how a typical multifamily housing cycle will look like from the supply demand dynamics point of view. So through this mini cycle, we saw a great benefit of the price easing, the pricing pressure easing, and the vacancy going back to the healthy level through this construction boom. And we certainly would like to see it more. We would like that to be a more consistent and sustainable theme rather than a sudden boom and then it just suddenly withdrew.
Yeah.
And to solve a more supply problem, and I do see a lot of the cities and municipals are laying out the red carpet, and they are really just cutting off a lot of the red tapes, which traditionally would be associated with constructing more housing. So a couple of trends that we are monitoring, which is the increase in the mixed income communities, right, which provide a lot of the lending opportunities because of the certain allocation, the percentage allocation to the lower income light tech units within the market rate property. And we see a lot of the zoning reforms, right?
Yes.
Allowing the commercial, the high rises to be built in the traditionally single family zoned area. We see some of the more ambitious plan, but some are more conservative. But we see, up and down, we see variations of that zoning reforms. The city of Yes for New York metros, right? That's one of the highlights for the past year. We also saw the continued push and public and private collaboration partnership on building more affordable housing. Because that is really the spot which allows us to address the lower income cohort Because if you look at the distribution within that median income growth, and you probably see a devastating gap when you put the actual dollar sign into that percentage growth, right? So up and down, you see the income continue to grow, but the base for the lower income family household to grow is much smaller than the higher income. So grow 10% on top of $1,000 gonna be so much smaller than grow that 10% on $10,000. So it's just simple math. So with that all being said, we see how the supply will come into the play to help us solve the affordability challenges, but bring up the awareness like what you did, Kathy, here over the podcast, and really just bring the developers, the government authorities and investors into this bigger picture. Going to be a very important step forward.
Okay, and Orphe, what about you? Do you see any hope in the future of us solving this affordability crisis?
I think that's the best. It's the good news, right? The good news is affordability is top of mind. You hear about it in the White House. You hear about it in the news media all the time now. It's an issue that concerns young workers trying to find housing near jobs on the coast. It also affects grandparents trying to find housing near their grandkids. Right? It's an issue that affects everyone. And so we're hearing more and more about housing affordability. And as a result, governments at all levels are now forced to do something about it.
Yes.
I think that's the great news. Look, in 2022, when mortgage rates more than doubled, we saw builders try to make the math work for potential home buyers by building smaller, building taller, building more attached units like townhomes and condos as opposed to detached single-family homes. There was an effort to squeeze more units in a smaller space because that's all people could afford, right? And so, so surprisingly, not surprisingly, a lot of people actually are leaning into density, higher density. People want, when we do our surveys, Zillow surveys for new construction buyers, they want community. Right, they want to live closer together. Right, it's renters, it's home buyers. Everyone is embracing higher density, and it just so happens that higher density makes sense when you have a housing affordability crisis. And so you're seeing buyers, but also builders leaning into higher density. You're seeing governments responding and allowing builders to do so. When you saw the past couple of years, the markets where land use restrictions were looser, right? We didn't have as strict zoning rules, were markets where you continue to see strong builder activity. And so hopefully we're going to see that across the country, as opposed to just in the South, right, where it's easier to build housing.
Oh, good stuff. Okay, well, we could just go on, but it was really such a pleasure to have you both here, Lu and Orphe. I hope you'll come back on the Real Wealth Show again sometime. It's been really a pleasure to have you here.
Pleasure to be here.
Thank you for having us.
Next time.
And thank you for joining me here on the Real Wealth Show. If you'd like to hear more about my personal housing forecast, you can get a recording of that or sign up for our upcoming webinar at realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.